Start recording, start broadcast.
The broadcast is now starting. All attendees are in listen-only mode.
Hello everybody. Hello again. Welcome to another Hot Forex webinar. Today we're going to cover a very interesting thing. We're going to make a small introduction about Elliott Wave's theory, okay, how you can apply it to the Forex trading. First of all, can any one of you guys give me some feedback regarding if you are listening properly, are you watching the screen is properly, please? Some can tell me some feedback. Okay, thank you very much, Mr. Abu Bakar. Mr. Patel, thank you very much. Well, guys, so let's start. Very well, if you have any audio or visual issues during this live broadcast, please check the settings on your computer or your device. Let us know through the chat or the question window. If you have any questions or you like longer explanations, then we have time for today. Please email us directly. And honestly, guys, take a piece of paper and a pen and write down this email address, webinars@hotforex.com. It can be very useful for you. Questions, things that you want to see covered in our webinars, please do it. We'll be very glad to assist you. Okay. A little bit about me. Some of you already know me. Okay, worked since nearly 15 years in all around the world, especially in the Latin American and Spanish and Portuguese markets in Forex, stocks, banking, investment. So I learned a lot about these worlds. I'm still learning every day. And it's complex world and complex language, but I try to make it simple to be accessible to the most of you. Okay. The legal disclaimer: this material is provided as a general marketing communication for information purposes only and does not constitute independent investment research. Nothing in this communication contains or should be considered investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that an investment in FX and CFDs products is characterized by a certain degree of certainty and that an investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written consent and permission. Very well, today, Elliott waves. We're going to go through the Elliott wave theory, the 5-wave pattern, the 3-wave pattern, the 3 rules, and then we're going to put it live on a chart, and guys, we're going to do this together, okay? I'm going to be very interactive with you. I want you guys on the chat interacting also with me. And then the Q&A, the question and answer later on, okay? Mr. Patel, thank you very much. First question. I will kindly request you to make the questions in the Q&A section, okay? So let's move on. Elliott Wave. Well, Ralph Elliott, this is the man responsible for this way that is simply amazing to see and analyze life, emotions, and also the markets, because markets are made by people, okay? This theory is very interesting because mixes a little bit of the crowd psychology, collective psychology, fractals, and also trading. Is amazing, guys, at least to study. It's very enthusiastic. So he developed this after intense study. He studied the behavior of the stock markets in nearly 60 years, okay? And at the same time, he was studying the behavior of the price section of the stock market. He was combining it with the general sentiment, for example, in geopoliticals, the fundamentals, the indicators, everything. And he combined it all, and he made, and he discovered that after all, there is Even the chaos may be organized, okay? You know, guys, it's not the chaos by itself. Like Nietzsche used to say, even the chaos, it needs to exist inside you in order to can create something new. So according to him, markets trade in cycles that repeat themselves, and these cycles are caused by emotions and behaviors of investors reacting to external factors. This is not a psychoanalyst session or therapy, okay? Don't be afraid, but it's a very, very, very interesting thing to study this. So the ups and the downs of the markets, he called them as the waves. And using some fractal theory and mass psychology study, he achieved his theory and published it in a book that I strongly recommend you guys to look at it, called the Wave Principle. Okay? The Elliott Wave Principle is a way of making some technical analysis to verify market cycles and try to predict market trends. Identify extremes in the investor's psychology reflected in their behavior, and as consequence is also reflected in the highs and the lows in the price section. It's all about collective and mass psychology, guys, okay? According to this principle, collective investor psychology moves between the optimism and the pessimism in natural sequences. This mood or humor variation can create some patterns evidenced in the price movements of the market. Okay? There it is, don't get scared. We go through this picture again. So in Mr. Elliott's model, prices alternate between the impulsive or the motive phase and the corrective phase. This is the same as saying that the impulsive or motive is the bullish momentum and the corrective phase is the bearish momentum. It subdivides the impulses in 5 lower degree waves, alternating between the different impulses and feelings, like 1, 3, and 5 for good mood, bullish, 2 and 4 for the bearish or bad mood, let's say it, movements, okay? So that alternation is shown below, as I told you. 1, 3, 5 for bullish, and the retracements on the waves 2 and 4. So market is bullish here. Some fundamentals of the general sentiment of the mass is not the best, and get depressed, get sad, and the market reacts to that emotions, come back, and then goes up again, and then that's it. Okay, 2 and 4 for bearish, bad sentiment, 1, 3, and 5 for bullish. Okay, we go further on this. Some of you probably are imagining that there are some coincidence in this kind of movements with the daily charts and or better with the charts of the assets that you see in your platform. Okay, so let's go to the 5-wave and the 3-wave pattern. Okay, that is the dominant and the corrective trends theory. Wave number 1, coming back a little bit here. Okay, fix this upper here, 1, 2, 3, 4, 5, and finish here. The ABC is another story, we go there after, just until this point. Okay, visualize this, 1, 3, 5 on the top, 2 and 4 on the bottom. Very well. Wave number 1. It's a number 1 point on the previous picture I show you. It's when the first wave of a bull market begins. Okay, so that means that most of the fundamental news still negative, but the markets start to show a little bit rising up, shearing up. Okay, the analysts still revise their earning estimates in a lower way. The economy probably does not look good. The sentiment is bearish, and it's time to make decisions. So this will bring the volatility to the market. Who is making this decision? Is the big investors, the big central banks, the politicians, whatever, is when the situation, the conjuncture is not the best, and they must act. And acting is equal as volatility. And bringing volatility to the market, the volumes might increase a bit, and with this the prices also rise a bit, but not enough yet to provide a strong signal. And then we have the wave 2. The wave 2 corrects the wave 1. It's a little bit the ice on the hot tea, okay? But attention, the wave 2 can never extend beyond the starting point at the wave 1. Otherwise, the bullish, the dominant pattern will not prevail. The general feeling still bad. Price is trying to get to the prior low, a small correction. Bearish sentiment is around, but the analysts start to change. So it's like the analysts got the real impression way before the common investor. Okay, and this is that's what they are doing now. Previously, the analysts they still revise while the investors were getting excited, let's say. But in the second phase is the reverse. The analysts start to see better future, but the market is retracing, okay? That's what I'm saying here. The general feeling is still bad. Price is trying to get the prior low. Bearish sentiment, but the analysts don't see that bad, okay? The market still is deeply volume, okay? Should be lower during the wave 2 than during the wave 1. Prices usually do not retrace more than the 61.8 Fibonacci level. It's very interesting to put the Fibonacci in the while you are identifying or labeling the waves, and you see that it looks like magic, okay? So the price should fall later on the third wave pattern, okay? Wave number 3, this is usually the largest and the most powerful wave in the trend. The news now and the fundamentals are positive, everything is getting better, people are happy, people are excited, people are trading, volumes are high, prices are crazily going up. Reminds me the stock markets a bit after Mr. Trump election, and that's it. Despite some people still negative and cautious, the big players are taking a look at the trend and enjoying it, okay? Now is everybody wants to catch the train. The wave 4 is typically, again, corrective. The prices may go sideways a little bit or a more extended period, and the wave 4 typically retraces bit less the 38.2 wave of the Fibonacci of the third wave, okay? And the volumes are below. Then the final wave is the fifth, okay, is the decisive leg in the direction of the trend. Almost positivity all around, everybody still bullish, and that keeps bullish, and that's precisely here when many average or small investors, they finally get inside, okay, right before the market achieved the top. It's a risky attempt. It's like they are try to join the train that is running, try to catch in the running train, entering the last wagon. And this is when sometimes things happen. Another good help to identify this kind of momentum is that the volumes start to be lower on the fifth wave than on the third, the big and powerful, okay? As well, the main momentum indicators start to show divergence or start to get bearish, like the fakes RSI I told you, I spoke yesterday and in previous live analysis, divergences between the MACD and the RSI, okay, it's very interesting to check this correlation. And then we're going to have the corrective trend. This is with the 5-wave pattern identifies bullish momentum of the markets, okay? Now let's going to see the reverse, okay? The ABC is the 3-wave pattern that is the corrective trend. Let's go back a little bit here. Sorry. Okay. Okay, so this was the upper trend, as you can see, until here, and now it's time the market to correct. A, B, and C. This is a bearish momentum, and if you put a kind of a trend line here, you see here a up momentum until here, and then collapse here. Okay, so let's go through it again. 3-wave. Simply 3 waves, the A, B, and C. Corrections in the A are harder to identify than the impulses. The end of the fifth wave. In a bearish wave A, the fundamental news still positive. Some see it as a correction, but in a still active bullish market. So the market is still bullish, but some can sound a bit of the correction. Some technical indicators that joining the wave A are showing increased volume, rising volatility, and possibly a turn. Maybe the Bollinger Bands are interesting here. Probably it's the time that they are stretching here, and the MACD and the RSI are getting overbought. Okay, the wave B is when the price is reverse is stronger. Okay, that which may be considered a coming back of the long gone bull market before. You may see the higher highs of the price action, let's say, a bit like as the right shoulder of a reversed head and shoulders. Okay, for those of you that know that what is a head and shoulder pattern, or imagine the reverse head and shoulder, and you see that is right a formation of the right shoulder, okay, on your chart. The volumes during the wave B should be lower than in the A. The sentiment, general sentiment, is no longer improving due to the fundamentals and not yet turned negative. People are trying to save their skin at the moment, okay, getting ready for the impact, let's say. And finally, the wave C, the price moved lower in that on the 5 waves previously. Okay, volumes are up, and by the third leg of this wave, everyone realized that the bearish momentum is solid. Okay, so the wave C must be at least as large as the wave A, and that's what gives you the definition. So basically, the Elliott wave so far, it can be a bit boring, this part, a little bit of theorics, but it's for you guys to understand the essence of this indicator. It is mostly about feeling, about sentiment, about action, reaction of the markets and the people to the news and the fundamentals at some technical, and apply that on the technicals. Because again, guys, markets is made by people. Okay? 3 rules. Because like on everything in life, we must have rules. This theory also have 3 main rules, okay, to help you to make the correct use of this momentum trend indicator. Those are related with a place where you may identify where the waves start and how they will perform after, in order to be confirmed with the momentum as impulsive or corrective, or, as I said before, bullish or bearish. Rule number 1. The wave number 3 can never be the shortest bullish wave on the impulsive momentum. Okay, should be the strongest and the biggest wave. That with this they can confirm that the formation of a corrective Elliott wave. Rule number 2, that the wave number 2 can never go beyond the start of the first wave. Let's say that you have a triangle starting on a, let's put a vertical lane when it's the 0, the -10, and above the 0 you have +10 and +20. Okay, the wave number 1 start on the 0, the wave number 2 can never go to beyond that line. Okay, does not give you a clear picture of the formation, Elliott formation, of impulsive Elliott formation. And rule number 3, the wave number 4, that used to be bearish, can never cross the same price area as the wave number 1. That is illogical, because the wave is almost finishing. Why should go back to the beginning? That will not show and will not confirm in the end the impulsive wave. Okay, so the bullish wave. Also, these rules sometimes can be broken. The market breaks it a bit, and most commonly with these 3 situations, the 5th wave does not move beyond the end of the wave 3. It's a truncation. Okay, stucks there a bit. That needs probably review analysis and adjust the levels of the wave. The wave 3 tends to be very long and sharp and extended, and the waves 2 and 4, they are the corrective. They bounce off the Fibonacci levels. Remember, guys, on the wave 2nd, that is a bearish, the lowest low must lay around the 7.8% of Fibonacci, and on the 4 on the 32.8 of Fibonacci. Okay, and this is more or less a basics for you guys to understand a bit about this theory. Now, after all the theory, let's go to have some action, and now I'm going to ask your cooperation, taking in consideration what you heard before. Now let's going to have some fun together. Let's go live on the charts. Okay, any questions so far? Okay, thank you. So let's see here some, if you find here some kind of waves. Okay, very well. As said before, you must start with a lower low and going up. Okay, and you must find a 1, 2, 3, 4, 5 pattern. Okay, before you see to try to detect a correct momentum, bullish or bearish, using the Elliott's. Okay, so let's try for this low and make a line, just a line from this low until the next consecutive higher. 1, maybe this. Okay, and now let's put a retracement of Fibonacci, just for curiosity, here in this. I'm sorry, it's not very legible, the Fibonacci. Sorry guys, try to put the Fibonacci a little bit more correct. Opa, why is nothing? I'm gonna change the background a little bit for you guys to see in a better. Sorry guys for this interruption a little bit. Let's put a little bit more grayish here. Okay, again let's gonna put, so the Fibonacci, as I was saying, first from this low here until, let's say, this level here. Okay, mark it here, the number 1 here. Okay, now let's put, by curiosity, let's gonna make a Fibonacci here. Okay, now let's see where the line can stay, the number 2. Remember guys that the number 1, sorry, I'm going to put this trend line on this point. This will be the number 1 here. Okay, now we're going to have the number 2, the correction. We're going to be near the 50 or the, never in this area. Must be always in this area, the 50 to 61 point range of Fibonacci. And there it is. Comes here, this low. Okay, it's in this area here. And now we can make a number 2 like this. And it will be the second. Okay, now let's gonna make an uptrend again. The market was okay, and curiously the fundamentals here are accompanying this mood. Okay, are accompanying this mood. This is the cable, the GBP USD is a pair that you are watching here. So we got a 1, 2 here, and then the market bounced back, optimism, Brexit, and comes here. 3. You see is the longest, is longer than this one and longer than this one. Is the longest wave all, must be here. Okay, now putting the Fibo again. Let's put the Fibo from this point to this point. Opa, sorry. Wrong. Fibo. There it is. From this point to this point. Okay. Let's gonna find. So have 1, the 2, and the 3. Let's go to the 4. The 4 must lay down on the level of 38.2, this area here, or 50 at the Fibonacci, this uptrend, okay? And there it is. It's here in this level again. Okay, so we can find the number 4 like here, more or less, this area here. And this is a short one. Okay, let's say this area here. And now you're going to make the fifth point that you're going to confirm or not if you have a impulsive Elliott or not. From here, go to the latest higher. It will be here, and you have the number 5, and after what happens at the number 5, the market used to crash and suits. And if you pay attention, this level here, or even this, if you want to put it here, okay guys, and these, the Fibonacci says it all. They almost match perfectly the Fibonacci, okay? This is a kind of 1, 2, 3, 4, 5 down, okay? It looks like easy, and it looks like the mana for the trading, but it's not. There are some other issues. Always put the Fibonacci, but at least you can see here 1, 2, 3, 4, 5, and after 5, bounce back, 3. Okay. 1, 2, 3, 4, 5. Mr. Sami, it is bullish. Look, from this one to this one, it's a bullish wave. Look at here. Just for this level. Okay, it was bullish. The other one is a correction. Okay, A, the B, and the C. This is possibly now what we may expect in this pair, according to the Elliott. That is the impulsive momentum finish it, and most probably, and you can see it here, this is a 1 hour chart, it's getting back. Okay, now we have the correction. The correction must start here in this level 61.8. So now let's go a bit back on the PowerPoint. Okay. The fifth drop. Okay, now let's go to the charts. Finish here, dropped here, and you'll have this movement here. Now start the A, pass it to here, will be this point. The magical number, 61.8 of Fibonacci. This is the A starting here. And if you see the PowerPoint, after an A becomes a correction, a B. The movement should not be necessarily this inclination. This is the trend, okay? That means that is an uptrend from the A to the B before the downtrend be confirmed. So again, on the chart, you can find the A starts here and now it's coming up. Maybe you have a formation of a B, where maybe you're going to test the 38.2 of the Fibonacci, this area here, before, and if breaks or not, but probably will be corrective and then will be down again. Let's see what these indicators say. MACD bearish, RSI bullish, diversion, okay? This is a diversion. It's the moment that the market waits to confirm this and the downtrend, so the corrective momentum is ready to start, okay? And let's put it on the 4-hour chart. Forget these lines. Yeah, you can see here some flagged moment and the bearish tendency according to the MACD, the RSI, and the stochastic even here. Bollinger Bears are stretching, indeed. Very well. Gentlemen, I recommended to you some books, okay, or Google some charts, some videos. There are some interesting videos that you can download regarding the Elliott Wave theory, okay, that can help you more practicing at home this and with some add-ons to your platform that you can make the better perfect triangles and that kind of things. And honestly, guys, this is a nice tool. Again, this is not my opinion. This is not my favorite for trading. This is just get the sentiment of the markets, you know, at least at the middle long term, how the markets are reacting. Okay, and if you put even in the higher, you can see, let's see the euro dollar, because Donald Trump, if you can put it like the day one, like, see, 1, 2, 3, 4, 5, bang, goes down, easy, or a kind of, okay, so let's say, sorry guys, could be 1, 2, here it is lower, and make it 3, and make it 4, here, and make it 5, here, and after 5, what will gonna happen, gentlemen? There it is. Bang straight to the A. And it's exactly what is going on now. With extra that the gaps normally, doesn't matter when, but normally they are filled up. So probably are on the way. Okay, gentlemen. Thank you very much for your time. Okay. Now let's go a little bit further. Any questions you want to put? Fair enough. I hope all of you take a good note of our email. Like Mr. Sami, thank you very much. Yes, soon you're going to be posted in our website on our YouTube page. Okay. Thank you very much, guys. So, Hot Forex app. I hope all of you have it. If not, Google Play or App Store, download it. If you are our clients, as I hope you are, the ones that are not, we'll be very glad to have you on board. Please use this app. It's free and is useful for you all. Forthcoming webinars, that's true. Next week we have Mr. Stewart, our guru, will be here. Okay. And by the end of the month, we're going to have lots to learn to him. He's an amazing individual and an amazing expert. He knows a lot. And guys, honestly, use the knowledge of Stuart, okay? And that's it. Analysis.hotforex.com or webinars@hotforex.com. We'll be more than glad to assist you, make your questions, suggestions, and hope to see you soon. Okay? Thank you very much. Have a lovely day all.